The Dow down more than 300 points. NASDAQ down 2%. It was up more than 4.5% this morning. The S&P closing below 5,000 for the first time in a year. It's also clocked its worst four-day loss since the peak of the financial crisis in 2008. But our next guest says there is one space insulated from tariffs and market volatility, which is private credit. Churchill Asset Management CEO and President Ken Kencel joins us on set. His firm was the most active U.S. buyout lender in 2024, according to PitchBook. Welcome, Ken. This notion of a safe haven is important because gold's not getting it done, treasuries, dollar, none of that is providing safety. Why is the private credit market so safe right now?
Well, look, I think obviously the events of last week have created a tremendous amount of uncertainty in the markets. And I think we're all in a bit of a wait and see mode in terms of how things play out. But I think private credit has always been a more stable and certainly diversified investment class. And look, I think from our perspective, we were in the midst of a record quarter in the first quarter. And you know, I'd say, at least for now, things continue to move forward.
But it's never really been through a recession or a crisis or a credit event. Will that test?
Well, COVID was, I mean, if you look at how we.
But didn't it really boom like to a much larger degree after COVID?
It certainly has.
Yeah. So are there cracks?
Not that we're seeing yet. Right. So I would say that obviously, and you wouldn't expect to see them at such an early point. But I would say overall, I think a lot depends on the timing of the dynamics that are playing out in terms of the renegotiation over tariffs, how long that takes, how long the market is living with the uncertainty of the current environment. But I would say as a general matter, you could very easily see the public markets, certainly the liquid credit markets, go kind of offline for a period of time. We did see that during COVID. And I think the private markets are there to be able to fill that void. So we have a tremendous amount of dry powder. Most of our counterparts with significant capital are there to provide that liquidity. And in periods of market dislocation, our markets tend to do very well. Spreads tend to widen. Covenants and structures tend to get better. Leverage tends to be lower as a general matter in the private markets. And I would say, moreover, if you look at our private credit focus, and we're fairly typical of private credit, we focus on companies that are primarily U.S.-based. I'll give you an example. 85% of the revenues within our portfolio today, we have about 600 U.S. companies in our portfolio. Underlying 85% are U.S.-based revenue, so less exposure to non-U.S. markets, therefore less exposure to tariffs. And I would say as a general matter, we tend to focus on more service businesses, which are, overall more insulated from economic downturn and volatility.
But Ken, first of all, it's been the golden age of private credit, and so congrats on that. And I think it probably will continue as an asset class. But if I'm cynical, I might say there's been such a flood of money chasing into this asset class, in some cases by investors that aren't really experienced, but I bet your investors are probably more institutional. But
they are.
One would say that there's a lot of money chasing, companies and maybe standards in terms of lending. And when you run into the type of pullback that we could see in a growth shock, it could expose lending standards, and where there's been this flood to put money to work and bring in money's coming in one door, we got to get out the other door. Talk about that and push back against it.
Yeah, no, Tim, I think that's a fair point. And I would tell you that there certainly have been new managers, coming to the table. But I would say overall, what we've seen over the last year or two has really been a bifurcation in the market. The larger, more scaled managers that can literally provide $400, $500, $600 million, $700 million, billion-dollar solutions, those managers with significant dry powder, with large institutional investor bases, with relationships to drive deal flow. For example, we specialize in private equity-owned companies. Those large-scale managers have generally been raising more capital. They've been taking share relative to the smaller players. So, for example, if you look at our portfolio today, if you look at our overall credit quality, the underlying default rates and non-accrual rates, very good. Today, our portfolio, less than 0.1% non-accruals across the portfolio. So I would say for managers that focus on higher quality, market-leading businesses like ourselves, I think we feel pretty good about credit quality to date. And certainly up through the first quarter, we were feeling very good about deal activity as well. So, I think it's a good time. I don't know if it's a golden age or not. I've said that before, but But certainly we see the current environment is still very conducive to what we do, and certainly providing liquidity if we do get a pullback in the public markets.
All right,
and that
well,
we've seen that before.
Good.